Good morning. This is Melissa Napier from Conagra Brands, Investor Relations. Thank you for listening to our prepared remarks for the Conagra Brands second quarter and first half fiscal 2025 earnings. At 9:30 Eastern Time this morning, we will hold a separate live question and answer session on today's results, which you can access via webcast on our Investor Relations website. Our press release, presentation materials, and a transcript of these prepared remarks are also available there. I'm joined this morning by Sean Connolly, our CEO, Dave Marberger, our CFO, and Matthew Neisius, Senior Director, Investor Relations. We will be making some forward-looking statements today, and while we are making those statements in good faith based on current information, we do not have any guarantee about the results we will achieve. Descriptions of our risk factors are included in our filings with the SEC. We will also be discussing some non-GAAP financial measures. Please see the earnings release and the slides for GAAP to non-GAAP reconciliations and information on our comparability items, which can be found in the Investor Relations section of our website. I'll now turn the call over to Sean.
Thanks, Melissa, and good morning, everyone. Thank you for joining our second quarter fiscal 2025 earnings call. Let's begin on slide 4. Our second quarter results reflect the fact that we continue to win with consumers despite ongoing economic pressures. We saw a return to growth in Q2 as we drove volume improvement, an organic net sales increase, and market share gains, demonstrating the continued strength of our innovation and strong execution by our team. These results highlight the enduring power of our brands and the effectiveness of our focused investments, which have reinforced our leadership in large, important categories. While we expect our top-line momentum to continue in the second half, our profitability will be pressured by higher inflation and unfavorable foreign exchange rates. Accordingly, we are updating our financial guidance for the remainder of the year. Our revised guidance reflects both our prioritization of continued momentum with the consumer and our expectation that the inflation relief we previously expected in the second half of fiscal 25 is still forthcoming, but in fiscal 26. As I noted, economic pressures continue to shape consumer purchasing decisions. We're still seeing value-seeking behaviors with consumers prioritizing affordability and maximizing value. Across the industry, manufacturers are deploying a similar playbook to address these challenges, increasing investments in advertising, promotions, trade initiatives, and innovation. These measures are designed to appeal to increasingly stretched consumers and drive growth. But the consumer response to these investments has varied significantly by category and by company. On slide 6, you can see Conagra's investments have driven a strong response. In Q2 of last fiscal year, I stated our commitment to invest more to put the inflation-driven volume declines in the rearview mirror with the goal of returning our portfolio to growth. Since then, we have seen our investments drive steady progress, and in Q2, it was satisfying to see that return to growth materialize. And since we believe future cash flows and long-term shareholder value will best be served by way of continued top-line momentum, our strategy will not change in the second half. Let's take a closer look at how this strategy translated into our performance this quarter. On slide 7, you can see how our proven playbook, which centers on modernized products and focused investments to support our innovation, have driven positive volume recovery in our key domestic retail business. This builds on the trends we've seen over the past year. And while the revenue mix was a bit different due to the value-seeking behavior shifts I discussed earlier, our track record of navigating today's difficult operating environment reinforces our confidence in continued volume recovery. The effectiveness of our strategy and resiliency of our portfolio are particularly evident on slide 8. Here you see our outstanding share performance throughout fiscal 24 and the first half of fiscal 25. 67% of Conagra's portfolio held or gained volume share in the second quarter, marking the 5th consecutive quarter of share gains. And our share performance is even stronger in our highly strategic frozen and snacks domains, where 87% of our portfolio held or gained volume share in the second quarter. Further, our share performance again outpaced our near-in peer set. In fact, slide 9 shows we outperformed our closest peer by 24 percentage points. Turning to slide 10, as I emphasized last quarter, our volume progress and strong share gains continue to be driven by our disciplined approach to brand building rather than heavy discounting. The industry merchandising environment remains rational, with 2 key metrics providing a clear picture: the share of volume sold on promotion and the average discount on promotion. Our volume share sold on promotion remains consistent with historical norms. Both today and in the pre-pandemic period, the volume of our sales on promotion remain below our closest peers. When we do engage in promotions, the discounts are targeted, reinforcing our commitment to thoughtful brand management. Said differently, Conagra remains less reliant on promotions to drive volume and maintains a disciplined approach to prioritize the long-term health of our brands. Turning now to our domains, beginning with frozen. We continued to see strong improvement in Conagra's frozen consumption, as demonstrated in our Q2 volume sales shown on slide 11, which have been improving for 5 consecutive quarters. And when we take a wider perspective, as shown on slide 12, our Q2 volume sales growth continued to outperform the total edible category and the overall frozen department as well. This growth is driven by a return to convenience, contributing to strong volume share gains in single-serve meal brands like Banquet and Marie Callender's, as well as increased share in Bird's Eye vegetables and our multi-serve meal brands. Taking a closer look at single-serve meals, our largest frozen category, on slide 13. Conagra represents the majority of volume in the $6.4 billion category, an outstanding achievement in today's dynamic and competitive environment. Our investments have enabled us to drive steady share improvement in this category, and in the second quarter, we increased our volume share position by 3 percentage points versus the prior quarter. Moving to our snacking domain on slide 14. Our snacking portfolio continues to perform well, although rising cocoa prices combined with delayed winter weather in many parts of the country contributed to the Swiss Miss decline. When you exclude Swiss Miss, snacks volume increased 0.6% for the quarter. As you've heard us say before, while products like Swiss Miss may experience short-term impacts due to seasonality and weather, these tend to recover as winter finally arrives and equal out over the year. Further, we continue to benefit from our advantaged portfolio spanning permissible snacking subspaces like seeds, meat snacks, and popcorn, where our brands saw increases in volume sales in the second quarter. Turning to staples on slide 15, we continue to see encouraging volume trends, delivering sequential volume sales improvement during the second quarter. This business provides tremendous utility to consumers and tremendous cash flow to Conagra. And some of that is coming from innovation. For example, we're excited about the continued strong performance of our chili business, including Wendy's chili, which recently introduced its new no-bean variety. This success underscores Conagra's ability to innovate to meet evolving consumer preferences. While we're happy with our top-line performance through Q2, we do expect 2 factors to pressure the second half of the year: inflation and FX. On inflation, last quarter, we told you we expected it to peak in Q2 and then fall in the second half, driven in part by lower costs on proteins. Our latest forecast projects that relief on protein costs will be delayed until after the end of the fiscal year. But to be clear, we do still expect these costs to fall as animal supply strengthens. We also expect some deflation on crop-based inputs as fiscal 26 unfolds. Given this updated outlook, we're not locking in commodity prices at the peak. Instead, we'll continue to monitor costs and prioritize the top line with the goal of going into next year with continued strong consumer momentum. Regarding FX, our international segment was impacted in Q2 by a strengthening U.S. dollar, which is expected to persist through the second half of the fiscal year. Despite our updated inflation and FX outlook for the second half, we're maintaining our commitment to our brand-building investments, recognizing their critical role in driving top-line momentum and strengthening consumer loyalty over the long term. We will implement limited new inflation-justified pricing actions in a couple of areas, which we expect will help offset some of the rising cocoa and sugar prices. At the same time, we remain disciplined in our efforts to maximize cash flow, prioritize debt reduction, and actively reshape our portfolio to position the business for sustainable success. Taking into consideration the headwinds we anticipate in the second half, as well as the dynamic consumer environment, we're updating our guidance for fiscal 25. We now expect to come in near the midpoint of our organic net sales range of down 1.5% to flat. Adjusted operating margin is expected to be approximately 14.8%, and adjusted EPS is expected to be in the range of $2.45 to $2.50. With that, I'll pass the call over to Dave to cover the financials in more detail.
Thanks, Sean, and good morning, everyone. Slide 20 shows our financial results for key metrics in the quarter. As Sean mentioned, Conagra returned to volume and organic net sales growth in Q2, driven by volume growth in our domestic retail business. Organic net sales were $3.2 billion in the quarter, up 30 basis points over prior year. Adjusted gross margin of 26.4% and adjusted operating margin of 15.3% were down 52 and 57 basis points respectively over the prior year, but adjusted operating margin was up 110 basis points in Q2 versus Q1. Adjusted earnings per share were 70 cents, down 1 cent from Q2 a year ago. Slide 21 shows the composition of net sales by segment. Total Conagra organic net sales increased 30 basis points over the previous year, with volumes up 40 basis points and price mix down 10 basis points. In grocery and snacks, we delivered net sales of $1.3 billion, representing 1.2% organic growth versus last year's second quarter, driven by increased volumes and favorable price mix. Our refrigerated and frozen segment also delivered $1.3 billion in net sales, flat to prior year. Increased volumes were offset by negative price mix, primarily due to our continued strategic trade investments. In our international segment, organic net sales declined 0.7% versus the prior year, driven by volume declines of 2.4%, partially offset by a 1.7% increase in price mix. Organic net sales in our Foodservice business declined 1% over prior year, as volume declines of 3.9% were partially offset by favorable price mix of 2.9%. While Q2 volume trends improved significantly from the first quarter, we still saw some ongoing softness in restaurant traffic as we discussed last quarter. Slide 22 shows our second quarter net sales bridge. Our 40 basis point volume improvement was partially offset by 10 basis points of negative price mix. We also had a 30 basis point foreign exchange headwind, primarily due to the strength of the U.S. dollar relative to the Mexican peso, and a 40 basis point headwind from M&A activity. As expected, the impact of reduced sales from our ATFL joint venture, which was sold in Q1 of fiscal 25, exceeded the additional net sales from our first quarter acquisition of fatty smoked meats. The components of our Q2 adjusted operating margin bridge are shown on slide 23. Adjusted operating margin declined 60 basis points over the previous year to 15.3%. We delivered a 2.4% margin increase from supply chain productivity, which was an acceleration from Q1. This productivity helped to partially offset the unfavorable price mix from our continued trade investments, as well as the 2.6% margin impact from unfavorable cost of goods sold inflation, which came in at 3.8%. We saw 10 basis points of favorability from lower advertising and promotion expenses, which offset a slight increase in adjusted SG&A. Slide 24 details our adjusted operating profit and adjusted operating margin performance by segment for Q2. Grocery and Snacks adjusted operating margin improved by 60 basis points, which included a $6 million benefit from insurance proceeds related to our previously disclosed canned meat recall in fiscal 23. Second quarter Refrigerated and Frozen adjusted operating margin improved 20 basis points from the first quarter, but declined 179 basis points compared to the second quarter last year, driven largely by our continued strategic trade investments and unfavorable impacts of higher cost of goods sold inflation and absorption. International adjusted operating margins improved 167 basis points, partially driven by the benefit of divesting the lower margin ATFL business. Finally, Foodservice adjusted operating margin improved 24 basis points versus Q2 a year ago. The adjusted EPS bridge for Q2 fiscal 25 is shown on slide 25. Adjusted EPS was 70 cents in the quarter compared to 71 cents a year ago due to a decline in adjusted operating profit, unfavorable FX rates, and lower equity earnings from Ardent Mills. This was partially offset by favorable pension income, interest expense, and adjusted taxes, which together contributed 3 cents of EPS in the quarter. Key balance sheet and cash flow metrics are shown on slide 26. Conagra generated $754 million in net cash flows from operating activities in the first half of fiscal 25. This is down from the prior year due primarily to lower operating profit and wrapping on the special dividend payment in the prior year from our Ardent Mills joint venture. For the first half of fiscal 25, capital expenditures of $215 million were flat to the prior year, and dividends paid were $335 million. We did not repurchase additional shares in the second quarter and had no new M&A activity in the quarter. Net leverage at the end of the quarter was 3.54 times, on track with our expectations. Slide 27 illustrates the continued strong performance of our free cash flow. In the first half of fiscal 25, our free cash flow conversion was 91%. As a reminder, given the seasonal nature of our business and working capital needs, we typically have stronger free cash flow in the second half of the year compared to the first half. We now expect our full-year free cash flow conversion to be greater than 100%. Our progress has allowed us to repay over $600 million of debt in the last 12 months as we move towards our long-term net leverage goal of 3 times, which we still expect to achieve by the end of fiscal 26. Slide 28 updates our fiscal 25 guidance numbers and explains the key drivers behind them. We now expect our full-year organic net sales growth to be near the midpoint of our guidance range of minus 1.5% to flat growth versus fiscal 24. As mentioned, we are taking limited pricing actions late in the third quarter to offset some inflation in cocoa and sugar, and we continue to expect our second half volumes and organic net sales to improve versus the first half. We expect brand investments to continue, with price mix being a larger headwind in Q3 due to investment timing, which may make our overall organic net sales progress in the second half nonlinear. We are updating our adjusted operating margin to approximately 14.8% as we now expect inflation to be closer to 4% versus our original guidance of approximately 3%. Our updated forecast of animal protein and egg inflation is not moderating in the second half as we originally projected in our guidance. We now expect this moderation to move into our fiscal 26. This higher inflation estimate will impact our second half adjusted gross margin. We now expect full year fiscal 25 gross margin to contract roughly 90 basis points versus year ago. Finally, as Sean mentioned, we are now expecting our adjusted EPS in the range of $2.45 to $2.50 due to the factors I just mentioned impacting our adjusted operating margin, along with 4 cents of estimated EPS headwind from unfavorable foreign exchange rates given the forecasted continued strength of the U.S. dollar. Slide 29 details our other assumptions for the fiscal year. As I mentioned, we now expect our free cash flow conversion to be greater than 100%. Additionally, we now expect to end the year with a net leverage ratio of approximately 3.4 times, up from our prior estimate of approximately 3.2 times. Importantly, we remain committed to repaying debt, and this increase in estimated leverage is fully attributed to our updated expectations for adjusted earnings, not our debt repayment plans, which are on track. We also now expect our adjusted tax rate to be approximately 23%, down from 23.5% based on favorability year to date. Our expectations for capital expenditures, the contribution from our joint venture Ardent Mills, interest expense, and pension income all remain unchanged. That concludes our prepared remarks for today's call. Thank you for joining us today. On a personal note, Melissa Napier will be transitioning to a different position in Conagra, the CFO of our grocery and snack segment. I want to thank Melissa for her leadership as head of investor relations and wish her the best in her new role. I want to welcome Matthew Nisis, who will be replacing Melissa. Matthew has worked in various finance roles at Conagra and will work closely with Bailey Ellis as he transitions into this role.
Good morning, and welcome to the Conagra Brands second quarter and first half fiscal 2025 earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star, then 0 on your telephone keypad. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. To withdraw your question, please press star, then 2. Please note, this event is being recorded. I would now like to turn the conference over to Melissa Napier, Head of Investor Relations for Conagra Brands. Please go ahead.
Thanks, Wyatt. Good morning, everyone. Thanks for joining us today for our live question and answer session on today's results. Once again, I'm joined this morning by Sean Connolly, our CEO, Dave Marberger, our CFO, and Matthew Nisis, Senior Director, Investor Relations. We may be making some forward-looking statements and discussing non-GAAP financial measures during this session. Please see our earnings release, prepared remarks, presentation materials, and filings with the SEC, which can be found in the Investor Relations section of our website, for more information, including descriptions of our risk factors, GAAP to non-GAAP reconciliations, and information on our comparability items. Wyatt, please introduce our first question.
All right, it looks like our first question comes from Andrew Lazar with Barclays. Please go ahead.
Good morning, everyone. Happy holidays.
Happy holidays.
Good morning.
Sean, we saw, I guess, during the course of the quarter, sort of a little bit of a gap open up between sort of scanner and sort of Conagra shipments. And I'm just curious if you saw any benefit from the Thanksgiving timing change on volume in the quarter that you would expect to reverse in the third quarter, just given others with sort of similar fiscal years have kind of discussed this dynamic.
Yeah, good idea, Andrew. Let's get grounded in some of the detailed facts around Thanksgiving because I suspect that this dynamic differs by company. For us, in our Q2, shipments were plus 1% and consumption was plus 0.6%. So they tracked very, very closely. And after the first half, our shipments and our consumption are actually equal. And this is an important fact, as we exited Q2, our inventory levels with customers were essentially even with a year ago. So there really was not a Thanksgiving timing effect for our company. Now, I can't speak to other companies' shipment patterns and inventories entering our Q3, but I can tell you that's our situation.
Thanks for that clarity. And then you talk about incremental inflation and FX as the key reasons for some of the back half EPS pressure versus previous expectations. Is incremental investment, whether consumer or trade, part of this as well? And I ask because it would seem you are seeing a return on some of the spending with the volume and share trends that you spoke of in the prepared remarks, and we continue to hear about the consumer being, more value-seeking for longer than many expected. So I'm just trying to get a sense if that is sort of part of the dynamic around estimate changes for the back half of the year or not. Thanks so much.
Yeah, good question, and I think it's very important we clarify this. As I mentioned in my prepared remarks, the decision to invest to drive the top line back to growth is not a new concept for us. We implemented that strategy in Q2 last year, and those investments have always been built into our plan for this fiscal year. And, as I said earlier, those investments are obviously working. If you look at our trend lines going back 5 quarters, it's been consistently going north. So we weren't surprised at all to see it break into positive territory this quarter, nor am I the slightest bit surprised to see real strength in our frozen and snack business. So that's satisfying, but it's good to be back north. As for the trade component of our investments, mechanically, we plan quarterly, and then we true up actual spend at the end of each quarter. In Q2, our actual spend came in a bit lower than planned, and we've redeployed those funds to Q3 versus cutting them. So I guess you'd characterize that as a small shift. But I think it's important not to confuse that with us being dissatisfied with top-line momentum and scrambling to add adequate support. We've had our support in place for 5 quarters. It's working, and we're going to continue to see it work going forward.
Thanks for the clarity.
And our next question will come from Ken Goldman, and we would like those to ask and limit themselves to one question. Ken Goldman, please go ahead.
Hi. In discussing the industry's higher investments in advertising, promo, trade, and innovation, Sean, you said the consumer response has varied significantly by category and company. I'm hoping to kind of unpack this a bit. From your vantage point, are there any best practices perhaps that can, maybe thoughtfully be applied to the industry as a whole, just given some of those, consumer challenges or those value-seeking behaviors?
Sure, Ken. Here's how I think about it. Somewhere in maybe Q2 of last fiscal that I first called out a series of behavior shifts that we saw, from cutting discretionary spending to more cooking from scratch to more cooking for many instead of meals for one, preserving leftovers as opposed to throwing them in the garbage. We saw all those things emerge last year, and what I've said all along is that the benefit of convenience is the one trend that has been most unshakable over the last 50 years. So we saw some impact early on frozen single-serve meals. I told you that was not going to last. Consumers don't like to meal plan. They don't like to prep. They don't like to cook, and they don't like to clean up. And that's exactly how it's unfolded. So my comment before is that really it's category specific. If a category has the benefits that consumers really long for, they can make a behavioral shift for a little while to make their household balance sheet work. But if those benefits like convenience are really important, that shift isn't going to last forever. The other area that I'd say is kind of a signal of what's on trend is within snacking. There's obviously been a movement toward protein snacks and healthy snacks, and our categories are squarely within that. So a year ago, we saw people were kind of trading out, maybe cutting their buying rate a little bit, but the magnetic pull of convenience and healthfulness and healthy snacking is pretty strong. So what we've done all along, as we've said many times, is we've nudged the consumer back to those behaviors that we know they're longing for, using a whole battery of investments, from an innovation to advertising to high-quality trade like end caps and sampling in certain channels of trade, things like that. And it's been effective. We don't have a lot of categories where it hasn't been effective, but we've keep in mind we've focused a lot of our investments in frozen and snacks, and we just happen to have brands that are resonating well with consumers in those spaces.
Thanks. Happy holidays.
Thank you.
Next question will come from Chris Carey with Wells Fargo. Please go ahead.
Hi, good morning, everyone. Can you just perhaps expand on your leverage targets for the full year, inching up a bit? Free cash flow conversion, it looks like it's coming in better. What's driving that? The leverage kicking up a bit, I assume, is more about profit as opposed to debt pay down. Can you just update us on, I guess, visibility on free cash flow, how quickly you think you can get to your leverage targets, and in general, how you're thinking about cash deployment, maybe over the next year and perhaps over the next several years between the dividend and share repurchases and, of course, M&A? Thanks.
Sure. Hey, Chris, it's Dave. Let me take that from the top. So yes, our forecasted leverage ratio for this year is now 3.4 times versus 3.2 times. As I said in my prepared remarks, that's entirely due to the takedown in our profit. So in terms of our forecasted free cash flow, we're on track with our plan in terms of how much debt we expect to pay down. The free cash flow conversion is now above 100% because that's a metric of free cash flow is related to net income. So with net income coming down, obviously that's going to go up. So, but the broader point there is we're really pleased with our performance in free cash flow. The company's very focused on it as an organization. And now that we've come out of COVID, we're really making great progress in working capital, particularly with inventory. Our supply chain organization is doing a fantastic job setting goals to take days of inventory out. Things like tax, just other areas of cash, we're just really focused on it. So we're really pleased with the progress, and it's going to continue to be a priority for us. So as I also said in my prepared remarks, we still expect to hit our long-term leverage target of 3 times by the end of fiscal 26. And so that's where we are. And then we've always talked about a balanced approach to capital allocation. Over the years, you've seen us do a lot of things in terms of, M&A, both, acquisitions, divestitures, share repurchase, paying, levering up and then paying down our debt. We're open to everything, and we like the flexibility, candidly, that we would have. But we are super focused on getting to that 3 times target for leverage by the end of fiscal 26.
Okay, thanks so much.
And the next question will come from Thomas Palmer with Citi. Please go ahead.
Good morning. Thanks for the question.
Great.
Wanted to ask, in the presentation indicate that the third quarter operating margin is expected to be the lowest of the year. I think this would then imply that 4Q would be the highest of the year. So I just want to make sure I kind of understand the key drivers of this expected inflection come 4Q. I know there is some incremental pricing. Are the investments you noted for the third quarter expected to taper off in the fourth quarter? Just any help on that inflection. Thanks.
Yes, let me try to give you some perspective on that. So kind of take it from the top. Let me give you a little bit more color on Q3. So we do expect volumes to sequentially improve, as we talked about in the third quarter. We did talk about, and Sean did a nice job of summarizing sort of the dynamic with trade and the shift from Q2 to Q3. So that's in there. We also have a little bit more kind of innovation investment, if you will, in slotting that's going to come in for Q3. That's impacting us there. We did comment that we do believe operating margin will be the lowest of all the quarters for the year. Our A&P and SG&A are going to be in line with a year ago. So it's basically that. And then from an inflation perspective, obviously we've taken up our forecast to close to 4% for the full year, and it will be higher in Q3 than Q4. So that's another kind of dynamic there. So, that's just the flow of how Q3 will go.
Thank you.
Yep.
And the next question will come from Peter Galbo with Bank of America. Please go ahead.
Hey, guys. Good morning. Sean, I just wanted to ask, I know you said there was no Thanksgiving kind of timing benefit to the quarter, but slide 15, you have the staples portfolio, with several of the brands that were kind of growing double digits. So just wondering if there was any hurricane impact in the quarter maybe that helped benefit some of the shipments that might not repeat, and if so, if you could just quantify for that for us. Thanks very much.
Pete, there was I would say, characterize it as a very small benefit from the hurricane in the G&S segment, but not material to our overall results for the quarter.
And the next question will come from Robert Moskow with TD Cowen. Please go ahead.
I think the Lamb Weston call took all the energy out of the sell side, so I'm going to try to inject a little more into this one. So Sean, you've raised your inflation guidance just a little bit, and it's had a pretty substantial impact to your earnings outlook. Is it more difficult than normal to put through pricing to offset higher costs because of where the consumer is right now? And I know the guidance assumes that these costs come right back down again, but some of them look a little sticky, particularly cocoa. So what happens if those costs stay high into fiscal 26?
Yeah, let me unpack that for you, Rob. First, taking it from the top, the EPS call down today equates basically identically to the inflation in the back half versus what we had previously expected. That's the majority of it, plus FX. So that cues up, and that is the reason, back to the earlier question around the leverage going from 3.2 to 3.4. It's not the need to invest more or any of that, and I want to make sure we don't get caught up in that. So so on a percentage basis, while it looks, 3% to 4% on a dollar basis in terms of inflation and the impact on EPS, it ticks and ties. As to what's driving that, it's really, yes, there's inflation in cocoa and sweeteners, and that's very small, narrow in our portfolio, and we will be pricing to offset that. But the bigger driver for us has been protein. It's meats, eggs, things like that. And we did anticipate that there would be inflation in the second half, but we anticipated that level of inflation will be lower. And we still anticipate that those peak protein costs are going to come down, pretty much across the board, but there's a bit of a deferral for that. So then it kind of leaves it as a judgment call for, companies like ours, which is, if you believe that the forward curves are going to be coming down, do you want to price, start the whole cycle all over again of the lag, the elasticity effect? And right now, we think what's in the best interest of the consumer and in the best interest of our shareholder with respect to kind of long-term cash flows and value creation is to keep the top line momentum. And that's what we're doing. It's been working very well for us. It was great to get back to positive territory. And so obviously there's a margin implication near term, but we do see that changing. Now, you never know. Like, we thought the back half was going to be less inflationary. If we find ourselves in next fiscal and there's more inflation, we'll deal with that then. But that's just a little color on kind of how we're looking at things now. And I think the headline is we've got really strong brand performance. We've got industry-leading share performance. We think the right thing to do is to keep that momentum.
Thank you.
And the next question will come from Alexia Howard with Bernstein. Please go ahead.
Good morning, everyone.
Morning. Hi, Alexia.
Just taking a little bit of a different tack, you announced your Healthy Choice GLP-1 on-track messaging recently. Can you talk about, what insights you've gathered from that segment and plans for maybe expanding that program over time?
Sure. Well, this is an opportunity for me, Alexia, to kind of give a little promotional shout out to our forthcoming CAGNY presentation this year. The centerpiece of our presentation at CAGNY is going to be titled "The Future of Frozen and the Future of Snacking." And really the point there is we think our categories are extremely well positioned in a dynamic macro environment, including a macro environment that has speculation around GLP-1s and regulatory and things like that. And we think, brands like Healthy Choice can really benefit in that kind of environment. And we think snacks that are protein-centric and fiber-centric as well. With respect to Healthy Choice, we did add what you might think of as a wayfinder on the front of the package for people that are, managing their diet proactively, including using GLP-1s. So the title of the wayfinder is called On Track, and we use the language GLP-1 friendly on there. And there was an article in the paper last week that kind of talked about that if anybody wants to dig into it more. But obviously it's small right now in terms of the number of people on it. People who do go on it are still dropping off of it. And what's interesting about that is a brand like Healthy Choice, we think, can be a solution for both somebody who is actively taking a GLP-1 drug, but also somebody who gives it up, but then is seeking to maintain the progress that they've made while on GLP-1s. Those consumers need a bit of an off-ramp, and Healthy Choice provides an excellent off-ramp for them as well. So we're on trend, and we will focus our marketing and our packaging to make sure people know that.
Great. Thank you very much. I'll pass it on.
And the next question will come from Max Gumport with BNP. Please go ahead.
Hey, thanks for the question. And this might be stealing the thunder from your upcoming CAG presentation, it sounds like. But Sean, you touched on the move within snacking to protein and healthy snacks. And really that's a microcosm for what we're seeing in the broader packaged food industry this year. You've got higher protein categories like nutrition shakes, cottage cheese, Greek yogurt, all leading on the growth side. And then you've got unhealthy snacking categories that are showing larger declines. In your view, what's driving this trend, and how long do you think it can persist? Thanks.
Well, snacking is, how big snacking is? It's $80 billion. It's a huge space, and it's a space that has always had a tremendous amount of variety. And depending upon what the hot macro trends are, you'll see some shifting within that space from variety to variety. It just so happens that for a whole host of reasons, things like protein and fiber are super on trend right now. And, who knows how that'll change. I don't see any change on the horizon in terms of protein and fiber being and low carb really being on trend. And so we are highly concentrated in our snack business in those benefit areas. And what happens when you get on trend like that is the categories grow and retailers add new brands to satisfy the demand. So when you think about big categories, in the food industry, you see cookies as an example. You see a lot of variety, and that's needed to satisfy demand. So that's why you see in areas like meat sticks, new brands showing up, because that's textbook, and that's why we acquired the fatty smoked meats business, because it's a new brand, it's playing that role, and it's growing at a super fast rate. So we now have in meat sticks what we call the trifecta smokehouse between Slim Jim, Duke's, and Fatty, and we think having a suite of brands there, just like we do in popcorn and seeds, is the best way to continue capitalizing on that growth. But I don't see those trends changing, and I like being protein-centric, fiber-centric, and I like not being DSD. That's a good combination for snack business.
Great. Thanks very much.
And the next question will come from Rob Dickerson with Jefferies. Please go ahead.
Great, thanks. Just a kind of quick, easy question. I might be wrong, but I thought Q2 was supposed to be the highest kind of spend for the year, just in terms of advertising and promotion. But then I also hear maybe there's a little bit more trade going into Q3, and I heard a little time shift. And then also, I think you said kind of, total SG&A and ad and promo would be the same in Q3 relative to last year's Q3, right? Which implies, Q3 is higher. So was there like anything that just kind of occurred in the quarter where you say, okay, hey, we might have a few new innovations that might have slipped into Q3, so maybe we'll also shift some of that ad and promo, or maybe we want to, promote a little bit more in December to the holidays. Just trying to gauge, kind of the, I guess it's seasonality to a certain extent on ad and promo, but just kind of how you're thinking about that as we kind of move through Q3.
You want to hit that?
Yeah, let me take that, Rob. just kind of take it from the top. From a dollar perspective, we spend the most in Q2 in terms of trade merchandising, just in terms of absolute dollars. Although Sean talked about it, we were a bit favorable to our forecast, and some that shifted to Q3. From an A&P perspective, we are ramping up A&P, so that will continue to ramp up so that by the end of the year, I think our A&P percentage is pretty much in line with the prior year is what we said. And so that would ramp up, and that obviously will start in Q3. I mentioned, too, that we did have a little bit of innovation investment that, was higher, that we expect to be higher in Q3 versus what we had forecasted before. Again, not really material, but it is an increase versus what we had forecasted before. So, and then SG&A, as you had commented, we're still kind of, our commentary is the same in terms of where we expect SG&A to be. So they're really the dynamics, I would say, that hopefully answered your question.
Yeah, Rob, most of those events are easy to plan. Thanksgiving and Christmas and Lent, where they fall in the calendar, you can plan around. The ones where you have to stay more agile is support for a business like Swiss Miss, where the weather moves around and you want to try to have your investment track with when the weather hits. But I wouldn't say that, that type of variability is material at all in the scheme of our spend.
Okay, perfect. No, that was great. Thank you.
Thanks.
And the next question will come from Leah Jordan with Goldman Sachs. Please go ahead.
Good morning. Thank you for taking my question. Seeing if you could comment on the competitive environment in frozen. A large peer has talked about adding capacity in the category and stepping up some investments to support its growth. So just seeing if you have seen any shift in behavior yet and how you think these changes could impact your ability to continue to drive volume improvement going forward.
Well, frozen is an absolutely awesome space. We've been saying that pretty much exclusively for about 10 years. So I'm glad people are starting to recognize the opportunity in the space, because it's a vast domain within the retailer store, and we've been really the only ones that have been active in driving that. And as a result, our products and our innovation machine is well out ahead of our competition. You can see that in extremely strong market share. So we love our model. We're just going to continue to drive it and lead it. And to the degree the retailers continue to appreciate how much upside and innovation space remains in frozen, the faster the overall category is going to grow. And we're the leaders globally in frozen, and certainly clearly in the U.S., as you can see by the share numbers, and we intend to stay that way.
Thanks.
Thank you.
There are no further questions at this time, and I would like to turn the call over to Matthew Nissis for closing remarks.
Thank you, Wyatt, and thank you all for joining us today. Please reach out to Investor Relations with any additional questions.
The conference is now concluded.
Happy holidays, everyone.
Happy holidays indeed. The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.